Good morning, everyone. We're going to get going now. So welcome to today's session. This is day 2 of the FAC course. So we have 3 sessions left today and 2 more. So that will give us our 4 sessions for FAC. What we're going to do over the next 3 lessons or the next 3 sessions, we will be working through the entire mock exam. And that should cover quite a bit of the topics that was listed in your the schedule that Tao shared with me. So in today's session, I'm going to spend quite a bit of time reading the scenario. What's important about it is for you to take note as to how I read the scenario. So as we go through, we try to understand the scenario. The whole point over here is not to read the scenario for comfort's sake. That is not to read the scenario just because you have to read it, but to read it with some form of comprehension, some level of comprehension, so you can understand what each sentence or each paragraph relates to. Then we will tackle one question, one of the requireds within the mock exam, and we'll just spread it over the next 3 lessons. Okay. Later on, we will do the MAC question. I'm selecting one still, and then we will do it a bit later. Okay. So I'm going to switch over now into my, I'm going to share my screen with the scenario. Then you can follow as we read. I was going to share my screen quickly. Okay. So you should see this the scenario on your screen. So I don't know if you have the paper or somehow you can make some notes. So just take note. Some things, remember, on a CTA level, they're trying to replicate the real world scenario as far as possible. So some information is relevant, some information is not relevant. So when I say relevant, so within the entire scenario, everything makes sense, but for what is required of you, not everything is going to be relevant. And that is what you're going to have to learn to understand that as an aspiring CA, when you get into the real world, not every piece of information is going to be relevant. You must take all the information available, what you have, and be able to decipher and pick out what you need for whatever is required of you. And that is why not everything will be relevant. Okay. In most cases, they always try to give you a background of a company, so you at least have some context. When you work for a company, when you're an auditor, the first thing an auditor does is to understand the entity, to understand the company they are busy with. If you're working in a company as an accountant or so forth, as you work through, you're going to have to learn about the company. As you do your job, you're going to have to learn about the company in order to actually understand why what you're doing makes sense. Okay, so in an exam, they give you some context of the background of the company, but it's not always going to be relevant for the scenario. But it's important to try to understand it, because that is how, if you pay careful attention to a scenario, you can learn quite a bit about, I mean, not a lot, but you can learn quite a bit in terms of having a decent basic understanding of an industry. If you really want to understand industries and get a good basic understanding, like I feel you really only understand an industry once you work in the industry. But as a student, the way you can get to learn an industry, just the basics, is to take, like for example, in South Africa, we have the Johannesburg Stock Exchange. So you will take the, let's say the top 3 companies or the ones you know. So for example, in food retail, I would pick out ShopRite, Pick n Pay, Woolworths, and maybe Spar, right? I'll take out those 3 to 4 companies, and I'll just read what the CFO has to say. I will read what the CEO have to say, and I'll read what the chairman of the board have to say. By just reading those 3 statements, they each one in every report, they will write their views, and then you'll get to understand the industry and the environment they operate in, and that's how you slowly start to get at least a gist of what the industry is about. Other aspects to read is like the business model, the strategy, and the risk. So that gives you a good understanding of what is happening within an industry. Why that's important, I'm not sure how your exams work, but like here with us in South Africa, once you write your honors, your CTA, you go write board 1, known as the ITC, International, Initial Test of Competence. Anybody sitting that paper. So you don't know who's sitting the paper. And many of these people are real world consultants and so forth. So they present a scenario based on what they know of the real world. So that's why it's good to get a understanding. Okay, but that is besides the point. I just want you to know that when you read a scenario, try to read it with understanding, but you must also know that not everything will necessarily be used in the requireds. Okay, just to give you some background and so forth. So let's get into it. So this CTA level 1, financial accounting, 2021, end of semester 1 mock exam scenario. So all amounts are exclusive of that unless stated otherwise. So how do I pronounce this? How do I pronounce it? Anyone want to tell me? Mwanezi. Okay, so Mwanezi. Okay, so Mwanezi was formed in 1992 when David Mwanezi realized the high demand of bottled water in Bridgetown due to lack of proper drinking water from the town council. Mwanezi started with 500 milliliters packed bottled water and experienced growth over the years, and now offers bulk supplies of both drinking and non-drinking water to the community. Mwanezi has a 31 December year end and prepares its financial statements in accordance with IFRS. Okay. So what's important in that statement, in that paragraph, that I think because we know it's a accounting question, so definitely what's important, the financial year end, it is 31 December of every year. Okay. You get an idea as to what the business is about. This guy, he packs bottled water. So what you know, packed bottled water, because that is what that's his service, what he sells. So as a result, when he sells packed bottled water, that is his normal course of business. So any sale of bottled water will most likely fall into IFRS 15, and any bottled water that is still in his warehouse or wherever it is would be inventory, because the bottled water that is unsold is still an asset because there's a future economic benefit. The question is, what type of an asset is it? It would be inventory. Why? Because it meets the definition of inventory. It is something that is sold in the ordinary course of business. And when he does sell the water, that would fall within IFRS 15 because it is a contract with a customer. Okay, so just take note of that. So that is basically the importance from that paragraph. Let's move on. Contract with Bridge Hotel. On 1 January 2020, Mwanezi was approached by the Bridge Hotel, which was looking for a permanent supply of water at the hotel. The hotel negotiated to have water delivered each month in the following package: 50,000 liters of bulk water suitable for cleaning, 10,000 liters of bulk water suitable for cooking, and 1,000 by Okay, 1,000 by 500 milliliters of non-branded bottled water for conferences, restaurant, and bar. Okay, so that is what they're telling us. So now we go to notes. So note number 1, Wenezi usually sells the bulk water at 10 cents per, how do I say that? 10 cents, 10, I don't know, 10 cents per liter and 20 cents per liter for non-purified and purified water, respectively. So non-purified is 10 cents and purified is 20 cents. Okay. Then note 2, 500 milliliter bottles water have a standalone price of 50 cents per bottle for non-branded and 75 cents for branded. Okay, so this is important. For IFRS 15, IFRS 15 deals with a 5-step model. Okay, so remember, he is entering into a contract or having these discussions regarding a contract where Wenezi sells water to the hotel. Now, if the agreement goes through, the hotel would be a customer of Wenezi. Why? Because they are transacting in a transaction where Wenezi is selling something in the ordinary course of its business. The ordinary course of Wenezi's business is selling water. So as a result, the hotel would become a customer. Now, when you're selling something in the ordinary course of your business, you need to have a look whether it falls within IFRS 15. And the way to go through it is to look at the 5-step model. The 5-step model, the 5 things are, number 1, identify or determine, identify a contract with the customer. Number 2, you need to identify the separate performance obligations. Number 3, you must then determine the transaction price. Number 4, you must then allocate the transaction price to the separate performance obligations. And then number 5, you must recognize revenue. Revenue can either be recognized over time or at a point in time. Now, you can see there's a negotiation happening over here. They will enter into a contract. The hotel would be a customer. Why? Because they are transacting in a well, the transaction is relates to an item that is being sold by Wenezi in the ordinary course of business, and there is a contract. They're going to have a formal contract. So that means step 1 of the revenue of the 5-step revenue model is met. Step 2. Now, step 2 and step 3, step 2 is very important. This will test quite often. So step 2, what is step 2? You need to identify separate performance obligations. In order to identify separate performance obligations, you need to identify one thing. And what is that one thing? Whether the goods and services within the goods and services that is being supplied are distinct. Okay, so whether the goods or services that are being sold are distinct. Now the question is, what makes them distinct? So you'll have to look at what makes something distinct. So basically it needs to meet 2 criteria. Okay, so the notes over here deals with that. Okay, whether it is distinct or not. So generally, when an item can be sold separately, when something can be sold separately, so you can see here what you could have separate prices for them, then they'll generally be distinct. Okay, but we will deal with that as we go along. So especially here, you can see they're telling you 500 milliliter bottles of water have a standalone price of 50 cents per bottle and 75 cents per bottle. Okay, so just be aware of that. And here they also tell you, Wenezi usually sells the bulk water at 10 cents per liter and 20 cents per liter. So there you can already see they have standalone selling prices. Okay, so that will come into play when we have to allocate transaction prices, but it also comes into play to determine whether things are distinct. So here you can see, if you have a look over here, suitable for cleaning is most likely non-purified, and then suitable for cooking is most likely purified, because you're going to consume it, so you need to have it purified. But if you're not going to consume it, you can have non-purified. So they usually sell purified and non-purified, so therefore these are distinct goods. And then they also have 500 milliliters of bottles. They have branded and non-branded. So once again, these are distinct. So most likely each one of these will be a separate performance obligation. Okay, but we'll read further if there's anything further if there's anything further that would change that. But up until point note 2, it seems that each of those three are separate performance obligations. Why? They are each distinct. What makes them distinct is that one of the criteria is, there must be 2 criteria, but let's talk about the one for now. The one is that they can be sold separately, and Wenezi do sell them separately. Okay. So the hotel agreed to pay $7,000 per month for the whole package, payable at the beginning of every month. Failure of each party to perform the obligations would result in a breach of contract. Both the hotel and Wenezi have been able to maintain their performance obligation as at year end. So there you can see it's a monthly package. So each month, let me just see, what is this? Yeah, so okay, so each month, so for the entire year, as you can see, they negotiated an entire package for all 3. So remember, step number 1, identify a contract. We identify the contract at the beginning. Step number 2, what did I say? Step number 2 of the model is identify the separate performance obligations. We identified that all 3 of these are separate performance obligations. Step number 3, determine the transaction price. The transaction price for the entire year is 7,000 times 12 months. Okay, so 7,000 times 12 months. Why? Financial year end is 31 December. They told us at the beginning that the contract would start at 1 January 2020. So for the 2020 financial year, it's a full year. So your transaction price is 7,000 times 12. Okay. But now step number 4 says you need to allocate that transaction price. You need to allocate the transaction price between the performance obligations. There are 3 performance obligations: the bulk, non-purified, the bulk, non-purified, the bulk, purified, and then the non-branded 500 milliliter bottles. Each of those are separate performance obligations. Why? They can be sold separately. Okay, so that means we'll have to work out a pricing and then allocate it based on a ratio. Okay, we will show you how to do that. Okay. So there is IFRS 15. So there's IFRS 15. Step number 5 would be, how do you recognize revenue? Remember, revenue can only be recognized in 2 ways. Either over a period of time or at a point in time. The way you work through it, if you read IFRS 15 carefully, you will understand that IFRS 15 says you must first test whether it is over a period of time. If it does not meet any of the criteria for over a period of time, then it must be at a point in time. Okay, so let's have a look. Let's read on customer compensation. So let's say on 25 November 2020, still in the current financial year, Wenezi was sued by one of their customers over a claim that they had experienced severe dysentery due to consuming intoxicated water supplied by Wenezi. The customer was suing for hospital bills incurred together with emotional damages experienced to the amount of $120,000. This is the first time that Wenezi has had a case like this ever since its inception. As at year end, the court was still pending. So what do we happening over here? Two possible scenarios, okay? No, it's not two possible scenarios. Two issues can come up in terms of accounting treatment. So the one is whether you must recognize a provision. So in IAS 37 deals with provisions, liability, provisions and contingent liabilities. So whether you must recognize a provision or whether you will disclose a contingent. Okay, so we'll have to have a look. Second, what could also happen after year end, we may have some more information. So we have to, it could be also events after the reporting date. Okay, so we'll have to have a look at that. So as at year end, the court was still pending and no ruling had been passed. After extensively investigating on the case, the lawyers of Wenezi are of the opinion that the chance of the customer winning the case is remote. Remote means it's unlikely, okay? Remote means it is unlikely. So, because something is at the, there is a case at year end. If it was not remote, if the lawyers was of the opinion that the customer would most likely win, then you would recognize a provision. But in this case, they are telling you that it is remote, meaning it's unlikely that the customer will win. So then you will, so that means it's not probable that you will be able to, it is not probable that you will, it is not probable that you will make a payment, so they most likely recognize a contingent liability. So not recognize, disclose a contingent liability. What's important, you must be able to distinguish between a liability, a provision, and a contingent liability. This all falls within IAS 37. A provision and a liability are both recognized on the balance sheet. So you will have on the statement of financial position on the balance sheet, you will have an amount recognized as a liability. Because a liability is a liability, so therefore you will recognize it on the balance sheet. A provision is also a liability. But what's the difference? The difference between a provision and a liability is that the provision have some form of uncertainty regarding two things, both or one of them, either regarding when exactly you will have to make the payment or the exact amount. You will have an estimate, but you may not have the exact amount. And or you don't know exactly when you will be paying it. You know you're going to be paying it, you just don't know when. So so that is the difference. A liability, you know the exact amount and you know exactly when you should be paying it. So for example, when you buy, so let's say Coca-Cola, Pick n Pay buys from Coca-Cola. Pick n Pay exactly know how much they owe Coca-Cola and they know when they're supposed to be paying it because they are agreed upon terms. But with a provision, here we're not certain the exact amount. We're still waiting on the ruling, right? And we don't know when the ruling will happen. So we don't also know when exactly we'll be paying it. So if the lawyers were of opinion that we most likely will be making a payment, then we will recognize something on the balance sheet as a provision, not as a liability. A liability and a provision is both recognized, but it's very important to distinguish between a provision and a liability, because when a user of financial statements look at the balance sheet and they see a provision, what goes through their mind, they know, okay, this is an estimate of what will have to be paid. This is not the exact amount, okay? But in this scenario, so we must still read the last sentence, we'll come there now. So far they said it is remote. When something is remote, they're basically saying it is unlikely that a payment will have to be made. So therefore we can't recognize a provision. Definitely no liability, but no provision. So we'll have to disclose a contingent liability. A contingent liability is not recognized on the balance sheet, but is disclosed in the notes to the financial statements. So when you disclose something in the financial statements regarding a contingent liability, you will have a heading in the notes to the financial statements called contingent liabilities. Under there, you have to put a few things in no particular order, but basically what happened, what is the reason for, what is the liability about, and what is who does it involve, and what is the claim. Okay, so if there's an amount, what is the expected amount? Okay, so that is basically the information you will put in. But what you will do, I don't know if you have the IFRS books. In IAS 37, you can just go to the disclosure in the standard that tells you what you need to disclose relating to a contingent liability. So here they're saying it's remote, so meaning it's unlikely. So we can't recognize it on the balance sheet, but we have to disclose it in the notes to the financial statements. So they're saying, since this is the first time such a case has occurred, there was no reliable estimation of the possible outcomes regarding the court case. So once again, it's confirming we can't recognize a provision. So therefore, we will have to disclose it in the notes to the financial statements as a contingent liability. Next, investment in the debentures. On 1 October 2020, Wenezi decided to expand its operations by drilling additional boreholes for easy access of water. In order to fund for the expansion, Wenezi issued 1 million 8% debentures with a face value of $2 each. So therefore the face value is $2 times 1 million, which gives you $2 million. And the debentures is 8%. So that is the coupon rate. So remember, the coupon rate is the agreed upon rate between Wenezi and the holders of the debentures. So basically the investors, whoever purchased the debentures, they are the investors, they are the holders. So basically it is an agreed upon, the 8% is your coupon rate, which is the agreed upon rate between Wenezi, the issuer, and the investors, the holder. So basically the interest that Wenezi would be paying to the holders would be 8% on face value. Remember, the payment is always face value multiplied by the agreed upon rate. The agreed upon rate is your coupon rate. So your interest, your annual interest payment is 2 million times 8%. Face value times coupon rate. The debentures were issued at the face value. So if it was issued at the face value, it means that the cash we received is the face value. So it's basically debit bank money came in, face value, which is 1 million debentures at $2 each, which is 2 million. Remember, if you remember the financial instruments class I had, that master class, financial instruments, whether it is a financial asset or a financial liability, at initial recognition, you must recognize it at fair value. Okay, so we'll have to have a look whether face value is fair value. The debentures were issued at their face value. The debentures were fully subscribed on the date of issue. The debentures are compulsorily convertible into ordinary shares, 1 ordinary share for 5 debentures at the end of the debenture tenure. Okay, so that means this is not an ordinary thing. We call this an embedded derivative, or a convertible. In financial management, they call it a convertible instrument. In financial reporting, they call it an embedded instrument. Okay, so what it means, we're going to say debit. We're going to say debit bank for the money we received, but the credit is not simply debentures. The credit is going to go between 2 things, partly for debentures and partly as ordinary shares. Okay, so we'll have to work that out. The debentures has a 5-year tenor. The coupon payment is due annually in arrears. Remember, the coupon is simply going to be face value times coupon rate. Similar debentures without a conversion option had a market interest rate of 9%, while those with a conversion option had a market interest rate of 10% on 1 October 2020. So remember, like we said, we need to work out the market value. Okay, so what we would do, that amount we must split between debentures and ordinary shares. So the way you work out the market value, we will use our financial calculator, but what's important, the interest rate we must use, they gave us 2 market interest rates, one with a conversion option and one without a conversion option. Because we need to split this instrument between debentures and ordinary shares, you must use the market rate without the conversion option. So if you read the accounting standards carefully, they'll tell you to get the liability component, you must use the market rate without a conversion option. And then the difference between the total market value and the market value of the debentures without a conversion option will give you the component relating to equity. So that's very important to take note. Okay. Wanezi paid lawyers' fees of $5,000 to facilitate the transaction. The debentures have not been accounted for in the financial statements of Wanezi. So here we have transaction prices. Okay. So remember, you must always ask yourself when you deal with financial instruments, whose perspective are we looking at it from? So we're looking at it from Wanezi's perspective. So that's important. You must always ask yourself, whose perspective? Is it Wanezi or is it the other party? Is it the counterparty? We're not looking at the counterparty's perspective. We're looking at it from Wanezi's perspective. Okay. So now the next thing would be, from Wanezi's perspective, what do they have? Are they on the financial asset side or are they on the equity and liability side? You can see they're on the equity and liability side. So with transaction costs, if you were on the asset side, when you're using amortized cost or fair value through OCI, you will capitalize, you will add the transaction cost to the asset. If it was through profit or loss, you will expense the transaction cost. That if it was a financial asset. But we know for Wanezi, it is not a financial asset. It is on the other side, either liability or equity. So in that case, if it's a liability, you will reduce the transaction costs. You will reduce the transaction costs. You will reduce the liability and the equity with the transaction costs. So what you can do, what we would do, we will split the transaction costs between the liability and equity. Okay, but I'll show you when we get to this question. I wanted to think through the various issues. On 1 November, Wanezi contracted District Development Fund to have 5 boreholes drilled at their site in Bridge. The DDF normally charges $75,000 for the complete installation of a single borehole. Due to the lockdown, DDF had no inventory to be able to drill the boreholes for Wanezi and would have to wait until the lockdown has been lifted in order to obtain materials for the job. In order to have the boreholes drilled in time, the 2 companies agreed that Wanezi would buy all the necessary materials required to drill the boreholes and DDF would provide the drill, rig, and labor. Wanezi bought the following materials. Okay, so there we have borehole, diesel, pipes, drill rig hire, other materials, transport costs, and labor. Okay, after DDF completed the installation of the boreholes, the council Bridge came for inspection and informed Wanezi that it would be required to restore the land back to its original composition at the end of the borehole's useful life. Wanezi estimated that the cost they would likely incur on rehabilitation costs would be $15,000 for each borehole. Each borehole had a useful life of 5 years. Okay, so this over here, falls within I-37. They call it restoration. Okay, so we'll have to have a look where we fall into. So remember, boreholes would be PPE for Wenezi. Why? Like Coca-Cola need machinery to produce Coke. So the way what you're going to get water is through the boreholes. Okay, so the boreholes is used in the production of income, or whatever they call it. So, and it's over. The boreholes last for 5 years. It is owner occupied and so forth. So therefore, it's tangible. So therefore, the boreholes will be considered PPE for Wenezi. Now, all of these stuff was incurred to get the borehole. So the question would be, which cost do you capitalize, which cost do you not capitalize? And then I-16 will tell you that restoration costs must be added. So we'll treat that in terms of IS-37. So a restoration cost, a provision for restoration, a provision for rehabilitation, whatever you want to call it, that will be added to the cost of PPE. The question over here is that they were going to get other company to do the entire job. But what happened was that most of the stuff was acquired by Wenezi, and as a result, so let me put it this way before we go into that. The typical way would be Wenezi just contracts DDF to do the entire job and pay DDF one full price. But because of lockdown, that could not have happened. So what happened? Wenezi went to go buy everything, and all they are doing is they are using DDF's labor, and they are using DDF's drill rig. So the question would now be, how do we treat this arrangement? Is it IFRS 16 leases? Is it what? Okay, so we'll have to have a look how to deal with that. Okay, we're getting there. Contract with Car4All. After drilling more boreholes, Wenezi had increased production capacity and was able to increase their daily cubic meters of harvested water from 1.5 million to 2 million cubic liters. This resulted in the need to have additional water delivery vehicles to enable them to meet the targeted demand. On 28 February 2020, still in the current financial year, Wenezi entered into a contract with Car4All for the use of 10 water delivery trucks. The contract specified that Wenezi would be able to hire an Ash Hock Leyland truck with a 10,000 liter water tank at any particular day, but did not specify any specific truck. Okay, now we're coming into IFRS 16. This is quite tricky with leases. So is the lease or not? Okay, this was because Car4All was ultimately responsible for any repairs and maintenance on the truck. Therefore, to have better control, Car4All required that all hired trucks be parked at the premises at the end of each day in order to better monitor the upkeep. Each morning, trucks were released on a first-come, first-service basis, since all water delivery trucks owned by Car4All had similar specifications: volume, capacity, make, etc. Car4All has over a 100 Ash Hock Leyland water truck for hire. The contract guaranteed that Wenezi would never be in a situation where there would not have been a truck available to them. Okay, so what you can see now, here is a contract in place. Okay, is an agreement in place where Wenezi has a right to 10 water delivery trucks every single day. Okay, for how long? Can't now see for how long. So the use of 10 water delivery trucks. The contract specified that Wenezi will be able to hire an Ash Hock Leyland truck with 10,000 liter waters at any particular day. Okay, so there you can see, so they want 10 water delivery trucks, which is a Ashok Leyland, which have 10,000 water liters. So you can see what is specified is that we're hiring 10 trucks, which is an Ashok Leyland of 10,000 liters. They're not specifying the exact truck, okay? And we will have to come every day. So as you get, so the question is the lease or not? So IFRS 16 does talk about this issue, okay? And it will fall, it will still be a lease, okay? So it will still fall within IFRS 16, even though the specific vehicle is not specified. Why? Because it's hundreds of the same vehicles. It's very impractical to specify it. So because it's hundreds of the same vehicles, it will still contain a lease. It is the same, like, I don't know which car rentals you have there, but here, for example, you have Bidvest, Avis, and so forth. They will, they don't tell you exactly the car, but they will tell you the range of the car. So, for example, Model A, Model B, or whatever it's called. Okay. Okay, so the contract specified certain routes that Uwanezi was allowed to ply with the trucks, and some of the roads in Bridge Rural were heavily dilapidated and would require high repairs and maintenance costs if the vehicles was allowed to travel there. Uwanezi was to hire the trucks for a period of 5 years with an option to extend for a further 5 years. So as you can see, it will still meet. On 28 February 2020, Uwanezi did not want to exercise the option to extend, as they were of the opinion that they would have made enough profits to acquire their own fleets by that time. So what's important when you have an extension period, an option to extend, you need to ask yourself at the inception of a contract, do you intend to extend? So here they say, no, they don't intend. So therefore the lease period will only be 5 years. If they did intend, then although the actual lease period is 5 years, you must include the extension period as well. So that means it would be a 10-year period. So just take note of that. Uwanezi agreed to pay $50,000 monthly for the use of the trucks. Okay. During the financial year, the board of directors were discussing on the possible ways to expand their market share. The marketing manager informed the board of the excess demand that Uwanezi was failing to provide for due to the limited routes that they were allowed to ply by Car for All. He explained his fear of having a competitor take over the unserviced market share if Uwanezi fails to come up with a solution on how to reach the prohibited routes. The directors of Uwanezi decided to hire some technocrats to teach their drivers on how to disable the tracking devices on the hired water delivery trucks in order to be able to reach the vast market share available without notifying Car for All. They explained that this was a good thing, as they were trying to provide water to the rural parts where it was needed the most. The CEO, who was the chairman of the board, applauded the other directors of such a selfless initiative, as he explained that they were doing this for a greater good of the community. Okay, so obviously there's an ethical issue over here. Okay, additional information. Uwanezi accounts for IAS 16 property, plant, and equipment using the cost model, except for land, which is subsequently carried at fair value. A post-tax market discount rate of 7 point whatever should be used where appropriate. Uwanezi has adopted IFRS 15 and IFRS 16 for its financial reporting purposes. Okay, so that is the scenario. We took a bit of time, but I just wanted to go in a bit of detail. Before we read the required, do you guys have any questions about what we covered, what I identified and what I mentioned and so forth? Anything still unclear, anything still confusing? Or can we read the required and move on to the next part? Justin, Kudzai, Taurai, Walter, anything?
Hi, Faz. Hello, can you hear me?
Yes.
Okay. on the contract with Car for All, I just have a question. You say that this is a lease. My question is on this statement, which says this is because Car for All was ultimately responsible for any repairs and maintenance on the trucks, therefore to have better control. So does this mean that Mwenezi will have control over the asset?
Yeah, so what they're trying to tell you over there is that it's not a disposal. Okay, so remember, Car for All have control.
Mm-hmm.
So from Car for All's perspective, because they are the lessor, from Car for All's perspective, the question would be whether they have an operating lease or a finance lease. So because they want to have control, it means they have an operating lease. So you won't account for it in Car for All's books as a finance lease, but as an operating lease. From Mwenezi is the lessee. Irrespective of whether Mwenezi has control or no control, you will always account for a lease in a lessee's book as if they have control. So you always have a debit right of use asset, credit lease liability. There's only 2 exceptions. Those exceptions will not apply to Mwenezi. I don't know if that answers your question.
Okay, yes, thanks.
Okay. Eddie, Justin, Tao, Walter, any questions from your side? Nothing? Yeah. Walter?
No questions.
Okay.
So clear.
Okay, so let's read the required and then we'll choose one of them. Okay.
Faiz, sorry, whilst you opening the question, confirm on there's under the same the lease part. Confirm there's the Mwenezi, they don't have a specific asset to say this reg number, and also they can get any of the vehicles that are the or the delivery vehicle. Does that affect the, what can I say, the lease or what?
No,
What's
so
the
you
impact?
see it's basically what vehicles do you have there in? There are similar vehicles like we have over here in what you call it. So let's say so all they are saying is so the agreement between Mwenezi and Car for All is that Mwenezi will get 10 trucks of 10,000 liters. That is a Leyland truck. Okay. Car for All have 100 exact same Leyland trucks. Okay. They're just not going to say that, remember, a specific vehicle would mean the number plate and everything of that nature. They're just saying there's 100. We're not going to tell you that you're going to get Leyland truck 1, Leyland truck 2, Leyland truck 3, Leyland truck 4. You're going to get any of the 100 Leyland trucks, any 10 of the 100 Leyland trucks. It is easier to manage that way. So it's still meeting the specifications. It's still meeting 10 trucks. It is still meeting 10,000 liters, and it is still a Leyland truck. So there's no problem with it. Okay, it is. It's not going to cause a problem for the lease. Just making it more manageable. And if you read IFRS 16, they'll tell you the same thing, that is okay, because it's still meeting the specifications. It is not something completely different. So that is totally fine. If it had to mean, if it had to be a little bit more strict, it would be an impractical situation for rental companies, because it's impossible to do it. So to give exactly the same thing every time, they're just giving you this any of the 100 that is available. So that is, so it will still meet a lease. Does that answer your question?
Yes, Faiz, yes. I thought there was a challenge there to say it has to have like specific number plate.
Yeah, no.
But if you say it means that, okay.
No, don't
No.
need that. That would be highly problematic. Okay.
Okay.
Thank you, Faiz.
Yes.
I think also to come in there and say something about Tau's question. I think I've also come across a similar example where I think it has to do with the shipping containers. So in that particular instance, you couldn't actually identify the particular ship container that this is the one that is your items, but still there is a list there, even though you couldn't get the particular shipping container. But it was established that the list is there, but it wasn't feasible for them to say, okay, of those 1,000 shipping containers, yours is this particular one.
Yeah, so it's going to be very, very difficult. You look at shipping containers, they're all the same. So a company will obviously mark each container because for their books, they want to make sure that they have all their containers, but they're not going to tell you container 10 is yours. They're going to say any of the 100 containers, any one of the 100 containers is yours. So ours is going to be an impractical situation, okay? So let's read through the various requires and we'll just go from A down, okay? Because we're going to cover the entire scenario. So we're going to just go from A, B, C. So we'll do A today. And then we will go through the various ones as we go along. So number A, discuss the accounting treatment of 1,000,000 8% debentures in the financial statements of Wenezi for the financial period 31 December 2020. Ignore presentation and disclosure, ignore tax implications, show all working communication, show all workings, communication, logical flow, okay? So what I want to give you guys, as an the four of you, I think it's 4 or 5, let me just check. Yeah, 5 of you. Just to discuss with yourself, I'll just put in, so that I'm going to put you into a group, the same groups, okay? Well, I'm going to put you into the group so that I don't hear your discussion. Okay, so I want you to discuss without me hearing how you'd go about this question, okay? And just as much as possible as you can. And then I'm going to ask you to give some feedback to me, and then we will work through the question together. I'll give you about 5 to 10 minutes on it, and then I will cover it. Then I'll go through it with you. Are you okay with that? I just want you to think about it a little bit, and then so I want you guys to discuss it. And then don't worry about numbers. You don't have to give me exact numbers, but you can maybe discuss how you'd go about calculating the numbers, okay? And then we will work through it together. So I'm gonna put you into I'm gonna put you into the same group. I want to hear your discussions, and then what I wanted to do, and then I'll call you out in about 5 to 6 minutes time. So here we go. Okay, you should get, and then please join the room. Tao and Walter, please try to join the group. Walter, please try to join. Thank you. Okay. You guys are back. You guys want to take me through it quickly? What did you guys discuss? Just 5 minutes, and then we're going to go through it together. Anyone want to just take me through what you guys discussed? Firstly, do you understand what the required is asking, and then tell me what did you discuss? Who wanna give it a stab? Anyone?
Sorry, I was talking to a muted mic.
Oh,
Yes. I think what we discussed, okay, we had not gone far, but what we only discussed was this is a debenture with the right of the holder of not the holder, the issuer has got the right to convert it to equity after 5 years. So what we had done was just to go and define what is a financial liability. And also we had mentioned the issue of the compound part, which is according to ISA 32 paragraph 28, the conversion now. But we had not now touched the classification under IFRS 9 now. I think that's where we're going.
okay. So you understand they want the accounting treatment for the entire financial year, because they said what was required now? The required said discuss the accounting treatment in the financial statements with the
I think this one required us to do measure, the initial recognition measurement.
Yes, so that's
and,
correct. That is correct.
Subsequent measurement.
Yes. So
Then I think we're not supposed to talk about, I think there are two issues that they say don't talk about in our scenario.
yes, so that is correct. You must look at it from the entire financial year. So it is from 1 January 2020 up until 31 December 2020. So the first aspect would be is initial recognition, right? So how do you recognize? So you will discuss that initial recognition. You will have to do three things: when to recognize, what to recognize, and how much. Okay, so remember, when do you recognize? When the counterparties are parties to the contract. How much? How do you recognize it? At how much? At fair value, right? So you're going to say debit bank, and then credit two things. You're going to credit a financial liability, debentures, and you're going to credit equity instruments, shares. Why are you doing that? Because there is a compound instrument or an embedded instrument. Okay, so you have a compound instrument in terms of the standard use I-32, whatever paragraph you spoke about. Okay, so that you'll have to do. Then you'll have to explain to them what will the numbers be. So we know the debit bank is going to be $2 million. Now that $2 million must be split between the liability and equity. So how do you split it? So basically you would have the 2 million rand, and then you must split the 2 million rand between the debenture, the liability, and the equity instruments. What must you do? You must find out the fair value of the liability, and the difference will be equity. Okay, so just take note of that. So you get the fair value of the liability, and the difference will be equity. So we have 2 million rand. So to get the equity, we must work out the fair value of the liability. How do we work out the fair value of the liability? So let me just open up Excel.
Hello, Faiz.
Yes.
Sorry, I just want to follow something. So you spoke about the embedded derivative.
Yeah, compound instrument. That's the more correct term. Yes. Yeah.
Okay, compound instrument. Okay, so the identification of the compound instrument is when it is being convertible into equity in the future.
Correct.
That is what makes it a compound instrument.
Correct. Yes.
debentures.
So it's not a pure debenture. It has a component element of an option. Okay, in this case, not an option, it's compulsory, but in another case, it could be an option. You deal with it in the exact same manner. Okay. So let me just share my screen with you. Does that answer your question, Justin?
Yes, yes.
Okay. So remember at initial recognition, remember you don't want to go into a lot of detail, right? But you must talk about initial recognition and you must talk about subsequent measurement. Okay, so remember it's only going to be two things, initial recognition and subsequent measurement. So remember at the initial recognition, what do you discuss? You must discuss three things. Number one, when do you recognize, how much, and the classification. Okay. Remember, in terms of classification, the big classification really only applies to a financial asset. We don't have any financial assets in here. Because remember what's going to happen, our journal entry look as follows. Our journal entry look as follows on 1 January 2020. Our journal entry would be receiving money. So it's bank, SFP, it's going to be 1 million debentures times $2. Okay. Then, so when do we recognize? On 1 January 2020, the parties were contract to the agreement, whatever it was, and as a result, on 1 January, that's when we recognize for the first time. On that date, we need to debit bank with the amount that we receive, and we have to recognize the financial instrument at fair value. This is a compound financial instrument. Why is it a compound instrument? Because it has a convertible option in place. This one, a compulsory one. As a result, on 1 January, because it is a compulsory convertible debenture, Wenezi needs to recognize the liability component as well as the equity instrument component. The liability component would be based on the fair value of a debenture. The debenture will be recognized at the fair value, assuming there is no conversion, and the difference would be going to equity. So this you must be very clear in your explanation that the liability component is determined by using a fair interest rate of a similar debenture without a conversion instrument. That is what you must make mention in your discussion, okay? So this is how you calculate it. The value would be as follows. We want the fair value, that is the present value. In order to get the present value, we need the future value. We need, what do we need? We need present value, future value. We need PMT. We need
NI.
N, and we need I. Okay, so future value is 0. There's no lump sum payment at the end. Let me just check again. I cannot remember the scenario. Debentures. Yeah. Okay, so remember, everything will be converted into oh, so if there's no debenture, we'll obviously, if there was no conversion option, we'd have to make a repayment of the debenture amount. Where's my Excel now? So remember, if there was no, remember, we must assume there's no conversion. So that means at the end of the 5 years, you'll have to make a payment back of 2 million. Are you happy with that? So remember, to get the liability component, to determine the liability component of the compound instrument, we calculate the fair value of the debenture assuming no conversion option. So if you're assuming no conversion option, that means at the end of the 5 years, you have to pay back the 2 million. Are you happy with that? That is why the fair value is 2 million. You're assuming no conversion. So the lump sum payment at the end of the 5-year period, which is your future value, would be the 2 million, your face value. PMT is your coupon rate. Our coupon rate would be face value times, our coupon payment will be face value times coupon rate. Face value 2 million multiplied by the coupon rate of 8%. N is the remaining number of years times number of payments per year. The remaining number of years on 1 January 2020 is 5 years, the full period. The number of payments per year is 1. So therefore it is 5 times 1. And then I must be the market interest rate of a similar debenture. Remember, what's a similar debenture? The one without a conversion option. So that one, I think if I remember, was 9%. Let me just check. Was it 9%? Similar debenture. No, wait. Yeah, so similar debentures without a conversion option had an interest rate of 9%. Now, if you read IFRS, if you read the accounting standards clearly, they will tell you to get the liability component, you must use the conversion, you must use the market interest rate without the conversion option. So without the conversion option is 9%. So now, what do we have? So present value, PV, they want the rate, they want N, they want PMT, they want future value, and then they want the type. The type is when payments take place, and that happens at the end of the year. So we make it 0. In your financial calculator, you won't put the 0, which your financial calculator will already be set at end of the year. So as you can see, the liability component is 1.9. So it is the 1.9. And then the equity component is the remaining balance. Equity. I think it's the ordinary shares. Yeah, equity, just a balancing figure. So it'll just be that minus that. So that would be the equity component. So at initial recognition, we will have liability and an equity. Why? There's a compulsory conversion. So therefore it makes it a compound instrument. Because there's a conversion option, whether it's compulsory or it's not, whether it's compulsory or it's still at an option of someone, it is still a compound instrument. Okay. So therefore, because of the compound instrument, because it has this conversion option, we have to split it between a liability component and an equity component. the liability component is determined by working out the fair value of the liability, assuming there is no conversion option. And as a result, the difference between that fair value of the liability and what the total amount received, the difference goes to equity. That is initial recognition. Subsequent measurement, what would happen? All you're going to do is we're going to account for the coupon payment. So at subsequent measurement, we account for the coupon payment. The liability will be treated using the effective interest rate method, because we're not using we're not using the fair value approach. Remember, for financial liabilities, you are always using the effective interest rate method, unless the company have elected to classify financial liabilities at fair value through profit or loss. Because I haven't chosen that, it will be using the amortized cost using the effective interest rate method. Okay, so we will deal with that, and then all we're going to have to do is, and then what you will say is that the equity instruments does not change. Okay, nothing happens to equity instruments. We'll only deal with it once after 5 years, once the actual transaction takes place. But throughout the period, there's no change to equity instruments. That is an important concept for equity. Ordinary shares, it never changes. Okay, that's a fundamental principle you must be aware of. Do you have any other questions? So the coupon payment for subsequent period at 31 December 2020. So at 31 December 2020, we're gonna make a payment, right? So therefore, what we're gonna do, we're gonna credit bank. Money is going out, so we're crediting bank SFP. What are we crediting? Face value times coupon, which is at 160 over there. Okay, so it's equal to the 160. For every credit, there must be a debit. For every credit, there must be a debit. What am I doing here now? So what we do to work out, remember the payment will be for 2 things. Yeah.
Can I interject?
Yes.
You, on our present value, on our calculation there, what we were told in the scenario was the issuer, not the holder, is gonna convert everything to equity.
Yeah.
In terms of the future value, are we going to change it? Because
Yeah.
there will not be any payments that will be made, everything will be changed to equity.
Yes, at the end of the 5 years. Why? What's confusing?
Because my thinking was, since the future value is gonna be 0, then my present value must change.
Yeah, but remember, you must assume that there's no conversion when you work out the liability component. That is what the standard says.
Okay.
So there's no conversion. That is what the standard says. Because we want to work out the liability component. There is a liability component. Because remember, every year you're still making payments. So therefore, we'll have to deal with that. Okay. But I'll double check the standard, but that is how I remember seeing it. Okay. So if I remember correctly, I'll double check. And if I'm wrong, I'll give you the correct one. Okay.
Okay.
Okay. But I don't, yeah. So the present value, to work out the interest is equal to PV times I. Okay, so interest PVI interest rate will remain that rate. Present value would be the present value at the beginning of the year. The current year is 2020, so the beginning of the current year would be, this present value will be the same. Remember, the present value will change every year depending on the year you're dealing with. Then we're just going to have that multiplied by 9%. So interest expense would be 172. I just do now. Okay. So this is going to be P&L, interest expense or finance cost, whatever you want to call it, doesn't matter. But you can see that the journal entry is not balancing. So we need to balance it, and that will just go against the liability. That minus that. So what would happen basically at the end of 5 years, the liability will be 0. Okay, so at the end of 5 years, the liability will end up or something like that. But what we will do is what will happen, I'll just double check. Okay, but this should be the way that it's done if I remember correctly. But I'll double check. But this is how you usually do a compound interest question. So let's talk about at initial recognition, subsequent measurement. So the initial recognition, you recognize fair value, you recognize, and then you need to classify. What do we know? There's a compound instrument, so you kind of need to split it out. Okay. And remember, you must also classify with the debenture. They never chose fair value through profit or loss. So we use the, I'll come now to there, Walter. We will use the standard approach, which is the effective interest rate method. That is initial recognition, quite easy, but this will be most of your marks for initial recognition. Then for subsequent measurement, only one thing is happening, and that is the payment happening at year end, right? So what are we paying? There is a payment made against, we're making a coupon payment every single year of 160,000 Rand. So definitely credit bank 160. But then as a result of having the debentures, there will be an interest expense. So we work out the interest expense and we need to balance this. So the balancing figure go against the financial liability. So that is what you need to put it in words. But remember, you must just make sure that this terminology come in clearly, especially you must use the market interest rate with no conversion rights when you work out the liability component. Remember, when you're working out the liability component, the whole idea is you're assuming that there is no conversion to get the liability component. Okay, but I'll confirm that issue you raised because you have some valid points over there. So, but I'll confirm. I don't need to. I'll read it up about a bit later. I think Walter had a question. Where's Walter?
Okay.
Walter, you raised your hand, I think.
Hi, guys. I just wanted to understand something. I've seen sometimes when we maybe do the present value calculation, we sometimes have adjust the interest rates. What would have happened when we adjust the interest rates or to adjust the effective interest rate?
Can you just speak a bit louder? Cody, what do you say?
I'm saying that I've seen scenarios where we adjust the interest rate to maybe after we find the present value, we adjust the interest rate. What would have happened in such cases?
You mean like for example, we agreed on 8%, but then later on the interest rate changed?
Something of that sort. No, it's okay. I'll just get a question, then I'll share with you.
Yeah, so that may result because there's kind of like from a financial asset point of view, there'll be some form of a modification and some form of impairment that we need to recognize. I share the question, then I can look through it and I can give you a better answer. Good, Zai?
Okay, I have a question as well. Why didn't we take into account the transaction costs?
Oh, you're right. Yes, you're correct. I totally forgot about the transaction costs. I'll deal with it now. Thank you for reminding. I totally forgot about the transaction costs.
Whilst you're getting into transaction cost, I want to answer Walter on the question that he's asking to say why will you be effective interest rate? Remember, they've calculated the present value, but we need to take into consideration the transaction costs. So we say present value minus the transaction costs. That would be the, what can I say, the new PV. Then you now compound the effective interest rate that will now be using to calculate the interest rate.
That's correct. Yes. I totally forgot about the transaction costs. So actually, thank you for bringing it up. So actually to make some kind of an adjustment over here now. We need to make a kind of an adjustment. Thank you, Kudzai, for pointing it out. I totally forgot about it. So for our bank, you can have two banks, so we can just net this off. So remember what happened. We received 2 million, but we also paid transaction costs of 5,000. So the net effect is that we actually only have that amount over there. Okay. We only have the 2 million that we received minus 5,000 we paid out. So we're going to have to make an adjustment over here. What you do, so generally what they would do, the transaction cost would look like this. Okay, so we have transaction costs, which is 5,000. But that now needs to be split. So that 5,000 Rand needs to be split between the liability and equity. Okay, so what we know, we can have present value. We're going to have transaction costs. And then we're going to have present value after transaction costs. Okay, so after transaction costs, PV before transaction costs. So we know the present value before transaction costs. It is going to be the negative of that, and this is going to be the 2 million minus that. Okay, so that is standard. The transaction cost will just be split between this in a ratio. Okay, so what you just say, liability divided by the total, which is 2 million, multiplied by the transaction cost of 5,000. So that's how we split it out. That's basically how it will look. So therefore, PV after transaction costs would be that minus the transaction costs. So we reduce the transaction costs, we reduce the equity instrument, and will just give us that amount. Okay. So there we go. So now the interest rate will change. So here, because of that, our present value, our effective interest rate will change now. So we can't use the 9% anymore, because this 9% is a market rate of a similar debenture without conversion rights. That's correct, but it didn't take into account transaction costs. So because our present value has transaction costs, we need to adjust our effective interest rate. So our effective interest rate would change now. If there was no transaction costs, our effective interest rate would equal to the 9%, because similar debentures without conversion, both have no transaction costs. But now this 9% is the market rate of debentures without a conversion cost and without transaction costs. Our present value is without conversion, but it is with transaction. So therefore, we need to work out a new effective interest rate. So we're gonna need I. In order to get I, we need present value, future value, PMT in so remember, what is our present value? It is always the amount at the beginning of the current financial year. Our current financial year is 1 Jan 2020. So therefore, that we're not using that amount, because that amount is excluding transaction costs. We need an amount including transaction costs. So therefore, we're taking the 1917. Present value still the same. Remember, we're assuming without conversion. So that means we're going to be making a payment at the end. But like I said, I'll confirm for you. But yeah, so I'll confirm for you. But if I remember the accounting standard, then because we're using without conversion, we must bring into account the 2 million. Then it's going to be, remember, payment's still the same. Payment doesn't change. 2 million face value times coupon rate. The coupon rate didn't change. Remember, present value and future value must be in the opposite direction. I always keep present value negative. Otherwise, the calculation won't work. And then N, we start at the beginning of the year. So therefore, it is 5. So to work out the rate in Excel, we type in the word rate. They're asking me for N. They're asking me for PMT. They're asking me for present value. Then they're asking me for future value. Then they want type. Remember, all payments happening at the end of the year. So I select 0. Remember, for when you work out the interest rate in Excel, Excel wants you to put in a guess. So you can make up anything. So I always just use 10%. So why I always use 10%? So just so you do not think about it. Okay, so I just use 10%. So there we go. The effective interest rate is that. And you see it's slightly different. 9.06, where that is 9%. So when we work out our present value, when we work out interest needs to be based on the one including transaction costs and the effective interest rate that takes into account transaction costs. So therefore, the journal would have changed. Okay, so the journal still remains the same, but the amounts have now changed. Thank you, Kudzai, for pointing out. I totally forgot about the transaction costs. So thank you for pointing it out. Do you guys have any questions? Eddie, Justin, Kudzai, Tao, Walter, any questions? If there's no question, we'll end there at this point in time, and then I'll share with us as soon as it's done recording.
Not from me, Faiz. Thank you.
Walter, does it clear your question? Kudzai?
Sorry, Faiz. Thanks, Faiz. That's what I was missing, the transaction cost.
Okay.
Thanks very much.
Okay. Kudzai, thank you for pointing out the transaction cost. Thank you. Tao?
Yes, for me, just to say, if it's saying an accounting treatment, it means you have to start from everything other than to say remove the recognition. It means I'll have start initial recognition, classification, measurement, subsequent measurement.
So almost, but so accounting treatment, yes, they're talking about initial recognition, subsequent measurement, and so forth. But what's important, you need to look at the year you are looking with. They said the accounting treatment for the current financial year, which was for the period ending 31 December 2020. So that means that financial year, which is 1 January up until 31 December 2020. So you need to ask yourself, what are all the journal entries that would have gone through that year? So in 2020, we had initial recognition. If 2020 did not have initial recognition, then you don't discuss initial recognition. You get what I'm trying to say? So they just asked us for the 2020 period. They said for the year ending, or for the period ending 31 December 2020. That is the whole year, 1 January to 31 December 2020. So you must sit back, looking at the scenario, and ask yourself, what journal entries should I be recognizing in that period? And based on that journal entries, you write a discussion. So on 1 January, there was a journal entry, which was initial recognition. Then no other journal entry after that. Then the next journal entry, 31 December 2020, which was the subsequent measurement in terms of the payment and so forth. So anything you need to do those journal entries, you discuss. If the same question, but the required says 2021, we wouldn't have discussed initial recognition because initial recognition is in 2020. Right? So just be aware of that. Okay. Does it make sense?
Okay,
Tao?
thank you.
Does it make sense?
Yes, it does.
Thank you. Any other questions? No? Okay, so I'll end here. Yeah, Justin?
It's not a question. Sorry, Faiz.
Yeah, cool. So I'll stop here. We're gonna stop.
Okay, sorry, just a quick one.
Yes.
I'm saying that we issued the debentures on 1 October 2020, not 1 January.
Hey, let me just go read the scenario again, please. Let me just go read the scenario again.
On 1 October 2020.
Let me just go read the scenario again. There were just too many things happening. I don't want to have confusions. Okay, so on 1 October 2020. Okay, all that's going to change, all what's going to change is our interest. So October, November, December, so it's 3 months. All that's going to change over here, we're going to say equal to 3 divided by 12. So interest is only going to be that multiplied by that.
Okay.
Okay.
So the PMT won't change. It will just be 160.
Yeah. So yeah. So let me just quickly see quickly. So we issued on 1 October. When does payments happen here now?
Annually in arrears.
Annually in arrears. Okay. So what would happen? All that's going to happen is the following. So I'm just going to keep that journal entry over there. I'm going to highlight it in. I'm going to highlight it in if it was 1 January 2020, that's how your journal entry would look. Okay, but that's not the case. So I'm just gonna highlight it in red. So because it was 1 October, the actual journal entry would look as follows. So no payment would have happened because the payment would only happen on, the payment's only going to happen on 30th September 2021. So on 31 December 2020. So remember, accounting deals with the accrual concept. So even though no payment have taken place by 31 December 2020, we have incurred interest expense. So we will still have interest expense. We will still have interest expense. We never made a payment, so therefore we have an obligation. So we'll just have here basically accrued interest liability, accrued interest, accrued in interest expense, SFP, with what we have to accrue with. Okay, so that is going to be the correct journal entry. Okay, so nothing else changes, just that. So just take note, I'm sorry, I obviously had to reread the scenario again. But anyway, so the thing was taken out on 1 October, not 1 January. So the first coupon payment will only be 30th September or 1 October 2021. So as a result, at 31 December 2020, no payment would have taken place. If a payment had to take place and it was an annual thing, like I thought it was 1 January, then this would be the journal entry. But because no payment is taking place, we have incurred interest, okay? Because we are using people's money for 3 months. So as a result, we are in accounting, we apply the accrual concept. And as a result, we have to accrue for interest for 3 months because we have incurred the expense. So so therefore we owe people the interest. So therefore it is a liability. You call the liability anything. A typical thing for an accrued expense is accrued expense. I'm just calling it accrued interest expense, so it's clear. Does that make it clear? I hope no confusion. Sorry for that. I had to just go read the scenario again. But that's the only change, basically. Are we okay with that? No confusions?
Yes, okay. You can just clarify for us, you can just find out for us about the future value, which Tao mentioned, the 2 million.
Yes, I will
Yeah.
I'll go read up. I need to read up on the standard, okay?
Okay.
Then I'll let you know. So thank you very much, guys. Thank you for this lesson. I hope you guys found it beneficial and learned. I want to make up that Mac class today. I just want to go chat to my wife to see, but she's studying for CFA and she has a report that is due to her. So that's what we kind of split time. So when I tutor in the morning, so like my time is basically up until 12 o'clock. And then it's my time to go look after the kids, and she does her work. So I just need to go negotiate quickly, and then I'll let you know the time. She knows I'm going to tutor again more, so she said it's fine. I just need to find out when it's best suited for her. Okay, but we will sort out that. We will sort out that. We will sort out that Mac lesson, what you call it, because I mean on par. It's only lesson that is so short is FAC, but I'm going to make sure we covered before your exam on 7th and 8th of June. Okay. Okay, guys, any questions? I hope you found it useful, beneficial, and you actually learned something. I'll see you in the next lesson soon. Okay, bye-bye.
Thank you, Faiz. We have definitely learned something there.
Thank you.
Thank you, Faiz.
Pleasure.
Okay, thanks. Cheers.
Bye-bye.